Now that a layer of uncertainty has been removed from the market, there will be clearer winners and losers from here. Joining me with some of those names is Charlie Bobrinskoy. He's the vice chair and head of the investment group at Ariel Investments. Charlie, good to see you, especially because, I've been wondering how much of a sell the fact move we might have, and it turns out the answer is none of one. So if people are now looking to chase this a little bit, where do you think they should be looking?
Well, I think one of the things that hasn't gotten enough attention this morning is that this is a relief rally against the uncertainty that a lot of people were predicting. A lot of people thought we weren't going to have a clear winner. We might have a contested election. We might even have riots on January 6th. And now all of that is off the table. And that's very good for the stock market. It's very bad for bonds. People buy bonds when they're afraid, when they're worried about a recession or a COVID panic. And that seems to be off the table. And that's a lot of what is going on today. What's really getting helped is small cap value. I'm obviously talking my book there, but you see the Russell 2000 value index up over 5.5%. And that's exactly the kind of sector that moves higher when there's a relief rally about less risk. Biggest
opening gap for the Russell since 2008 and 2020. So it has a lot of catch up to play. Are you concerned that high rates are going to be remain an earnings headwind for that, or no?
Fascinating. Small companies don't borrow treasury levels. They borrow bond yields, and bond yields, I think, are actually going to tighten a little bit here. So the actual issuance level for a mid-sized company is probably not actually up as much as the rates are, the government rates are. So in fact, I'd be even a little bit bullish on short-term rates coming down. A lot of these companies have short-term maturities, short commercial paper, and the rest. Short rates are coming down, and it's the long end of the curve is actually pretty good for the corporate bond market.
So, Charlie, Goldman Sachs, let's look at some of these banking stocks. And it's something Michael Kantrowitz said the other day. The bankers are coming, and that was before the election results. And now if there's a green light for more deal making, you can just add that spur. So Goldman, which you like, is up sharply. Stifel, we talked about this lately. It's up 60-70% year to date now. How much more could these stocks run?
Well, they're not nearly as cheap as they used to be. I always use the metric with you about Goldman Sachs, and buy it at 1, sell it at 2. And that means buy it at book and sell it at 2 times book. And Goldman Sachs got below book, not more than about a year ago. It was below book. And now it's rallied, and it's still under 2 times book, but it's getting close to 2 times tangible book. If you back out goodwill, we're getting pretty close to 2. So not nearly as cheap as it used to be. Short term, all kinds of positive momentum. Very importantly, the yield curve is very positive for investment banks. Investment banks tend to borrow short and own longer term maturities. And so a normally sloped yield curve is going to have a very positive effect on their near term earnings. And then there are going to be a lot of deals. There's going to be a lot of IPOs. The short term outlook for Goldman Sachs is very good.